Hi, I hope you all are doing really well. This is Ritika and we are doing reading 30th of corporate issuers called Cost of Capital. This is LOSE and this LOS requires us to calculate and interpret the cost of equity capital using the capital asset pricing model approach and the bond yield plus risk premium approach. Earlier DDM approach was also a part of this LOS which now isn't. So let's begin with the CAPM or the capital asset pricing model. The capital asset pricing model was developed by William F. Sharp, John Lintner, and Jan Mawson. This model establishes a linear relationship between the required rate of return of a security and its systematic or undiversifiable risk or beta. Graphically, it is a straight line that shows the relationship between expected return on equity and market return. It could either be an upward sloping line if the relationship between the market return and the stock in question is positive, or if the relationship is negative, it will be a downward sloping line. Mathematically, this model could be represented using this equation. Here, RE is the expected return on security, beta J is the beta of the security J, RF is the risk-free rate, and KM is the expected market return. You can select the risk-free rate of return on the basis of duration of the project's cash flow. So if the duration of project's cash flow is expected to be around 10 years, then a risk-free rate on the government bonds, etc. of a similar duration should be considered. Beta is a measure of volatility or systematic risk of a security or a portfolio in comparison to the market as a whole. It should be estimated relative to the market index. We'll discuss the calculation of beta in detail in another video. This term KM minus RF is the expected market risk premium and also referred to as equity risk premium or ERP. It is an extra return that you get for taking risk instead of investing in a risk-free bond. Here, as per this model, we use beta of the security to estimate the risk associated with the project. Sometimes a single beta is not enough to capture all the risks. In such cases, we use the multi-factor model with multiple betas. And this is the equation for a multi-factor model. Now, how do we estimate equity risk premium or ERP? You can use one of these models to estimate the ERP. The first one is historical equity risk premium approach. So there are basically two main components of ERP and they are market return and the risk-free rate. Here, as per this model, we make use of historical data to find out the average market return and the risk-free rate of return. You can find any historical data of any company as well as the market indices easily these days on Google, Yahoo Finance, Bloomberg, etc. While using this approach, you must consider different periods to average the rates. You can take a 1-year period or a 5-year period or a 10-year period, whatever you want. You can also consider overlapping versus non-overlapping time periods for calculating the averages. For averaging the returns, you may use either arithmetic or geometric mean. A geometric mean may also be used to measure the profitability of investment over a multi-period horizon. But there are some limitations of using such an approach. First, the level of risk of an index can change over time, so historical averages might not even be relevant at the present time. Then second, the levels of risk aversion can also change, again making the historical data inappropriate. Then third, estimates are sensitive to the methodologies of choosing that we use. So that can be a big limitation. Now moving on, the second method of calculating the equity risk premium is dividend discount model or the implied risk premium approach. This approach is implemented using the Gordon growth model. And as per this approach, the market returns are reflected in the long run trends of growth rates. Now, assuming a constant rate of growth of dividends, This equation shows how the price of security is calculated. And in this equation, we replace the market values for the stock values because we are trying to find the expected return on the market. So D1 here is the dividend expected in the next period. This here is an assumption based on historical data and other information available. P0 is the current market value of the equity market index instead of the security. RE is the required rate of return on market and not an individual security. And G is the expected growth rate of dividends. When we solve this equation for the value of RE, we get the value of required rate of return on the market index, which is this. This value of RE is considered as the market return, and we reduce from this the risk-free rate to get the value of ERP. Now the third way of calculating the ERP is the survey approach. According to this approach, a panel of experts is asked for their opinion as to what should be the market rate of return. The average of all the responses is considered as the market rate of return on equity. And from the resulting figure, we reduce the risk-free rate, which may also be suggested by the experts to arrive at the figure of ERP. Now let's move to the bond yield plus risk premium approach. As per this approach, the cost of equity to a company equals the corporate bond yield plus some premium. That is a spread representing the premium against the risk on investing in equity over the bonds. And this risk premium may be calculated using one of the approaches we just discussed. So this is the equation. The risk premium is usually estimated from the historical spreads between stocks and bonds. Let's do a few questions now. The first one says, using the dividend discount model, what is the cost of equity capital for Zeller Mining if the company will pay a dividend of $2.30 next year, has a payout ratio of 30%, a return on equity of 15%, and a stock price of $45. And the options are A, 9.61%, B, 10.50%, or C, 15.61%. So for DDM, we first need to calculate the value of G. And what is G? It is retained earnings multiplied by the return on equity. So this is the equation for calculating the value of G. And this term here represents the value of retained earnings. So G is 1 minus the dividend payout ratio, that is 30%, multiplied by the value of return on equity, that is 0.15. So G is 0.105. And now that we have the value of G, we can calculate the return on equity using this formula. So the return on equity is 2.30 divided by 45 plus 0.105. So return on equity is 0.1561. Option C is correct. The next question says, Brandon Beanie is a financial analyst covering the beverage industry. He is evaluating the impact of DEF Beverages' new product line of flavored waters. DEF currently has a debt to equity ratio of 0.6. The new product line would be financed with a $50 million of debt and $100 million of equity. So there will be a change in debt equity ratio. In estimating the valuation impact of this new product line on DEF's value, he has estimated the equity beta and the asset beta of the comparable companies. In calculating the equity beta of the product line, Winnie is intending to use DEF's existing capital structure when converting the asset beta into project beta. Which of the following statements is correct? Option A, using DEF's debt to equity ratio of 0.6 is appropriate in calculating the new product line's equity beta. That's clearly not correct. Option B, using DEF's debt to equity ratio of 0.6 is not appropriate, but rather Debt to equity ratio of new product, that is 0.5, is appropriate to use in calculating the new product line's equity beta. Or option C, Vinny should use new debt to equity ratio of DEF that would result from additional $50 million of debt and $100 million of equity in calculating the new product line's equity beta. Since Vinny is calculating the beta of new project only and not that of the whole company, he should only consider the debt equity ratio of new investment, that is 0.5. So option B is correct. If, however, he were to calculate the revised beta of the whole company, then it would have been appropriate to add the value of additional debt and equity to calculate the debt equity ratio as suggested in option C. But since here he only has to calculate the value of beta of new investment, option B is correct. Moving on to the next question. An analyst gathered the following information about a company and the market. So we have current market price per share, most recent dividends per share, expected dividend payout rate, expected ROE, beta for the common stock, expected market return and risk-free rate of return. Now using capital asset pricing model, we have to calculate the cost of retained earnings for the company. And we are given the options A 13.6%, B 15.7% or C 16.1%. So this is the equation for CAPM. We thus need the risk-free rate, beta and market returns. So the cost of equity using this equation is risk-free rate, that is 4%, plus beta, that is 1.3, multiplied by the equity risk premium, which is market return of 13% minus the risk-free rate of 4%. So we have the cost of retained earning, that is 15.7% or 0.157. So option B is correct. So that's all with LOSE. Check out the practice questions and study material for this topic at ProCFA.com. If you have any trouble getting through this topic or any other topic, write to us. We'll get back.